Hey, Des, New York, how is it going? Tom, Konstantin, really glad to have you guys here on the main stage today to talk about payments. Maybe before we dive into, there's a lot of excitement around payments and agentic payments and all these different things going on, but I'd love to maybe just start with a quick background, what you're doing at Swift, what you're doing at Blockdaemon. Talk to us a little bit about background and kind of where things are going for you.
Great, okay. Well, thanks for having me and congratulations on a really successful event so far. It's quite a turnout. I'm Tom Zschach. I'm the Chief Innovation Officer for Swift. I've been in that role for just over 6 years now. I'm based in New York, even though we're headquartered in Belgium. And I guess for us in the last several years and kind of leading up to an announcement that we made at the end of last year, really the focus has been on digital assets and how can banks and traditional finance companies step into digital assets in a significant way. And we announced the ledger last September. We're going through the process of kind of explaining what that is. We're not changing what Swift is, and that's probably pretty good context for this conversation. And Swift's a network. You know, we don't issue tokens, we don't hold value, we're not a custodian, we don't do settlement. And it's really kind of the trust fabric that's used globally by over 11,500 banks and financial institutions in 200 different countries. So really interesting time, lots of things happening, and looking forward to this conversation.
Yeah, definitely. Konstantin?
Yeah, I'm the CEO and founder of Blockdaemon. Blockdaemon is a sort of quasi-crypto native infrastructure company, and really what that means and why I'm on this panel is we sell two distinct products. The first is on-prem wallets that we launched in 21 that have not been very popular really up until the Genius Act passed. And so we have on-prem wallet and signing capabilities for institutions. And really what that means is it allows institutions to sign digital transactions and have, multi-party policy encrypted on-prem. And so suddenly we find ourselves with a wallet that is uniquely positioned to support agentic payments and transaction settlement. And we also sell nodes that you need for liquidity sequencing and monitoring and all those other things that come with any sort of agentic-driven payments and transactions. And so I think the last thing, what's unique about Blockdaemon is we also have JP Morgan and Goldman and Citibank as major shareholders, and public customers of our service range from all those to the Fidelities and Bank of New York's and so forth. And so we're sort of all over all these different institutions trying to explain to them how crypto native infrastructure relates to existing financial rails.
Awesome. Thanks for the background, guys. I think maybe what we can do is start with a hot narrative right now. Agentic payments, I think, is on everyone's lips right now. But I think it's pretty questionable and maybe up in the air what that actually means today. So maybe, Tom, if you could start off and just explain, what are the caveats? What does agentic payments mean? Where do you see that really impacting maybe what Swift does and large institutions?
Yeah, I mean, the signal-to-noise ratio on agentic payments it's probably off the charts at this point, right? There's so much hype and so many stories that are out there. I mean, what we're really talking about is instead of a human making a decision directly, it's going to be done by an algorithm, right? In kind of really simple terms. And you can apply that in a retail or consumer environment, or you can apply that in an institutional environment. I think we're probably a ways away from kind of full automation in the institutional environment, just especially when you look at kind of cross-border. But I don't think it's a completely new topic. Having spent a lot of time on trading desks, for example, in investment banks, and knowing how the hedge fund industry works, they've been trading automatically, for taking positions and placing orders and doing hedging and moving cash, for decades. And so we didn't call it agentic AI at the time, but we called it algorithmic trading, right? And the banks have been offering that for decades. And so I think what comes along with that is, do you have the control structure in place? Can you manage the risk? Are you going to, can you deal with that time where something goes crazy and you don't end up doing a fire sale of the institution as a result of that? But I do think we have a ways to go in that, but I think it's going to move probably faster than people think in practical ways, like way liquidity moves, way things are hedged, cash and treasury management functions. I think those are going on a path pretty quickly to start to be automated pretty, in the not too distant future.
Konstantin, I'm wondering, do you have a different perspective maybe from where you sit with interactions with your customers? Do you see a credible and near-term path to agentic product offerings?
Yeah, I mean, the way I think of agentic payment, I mean, it's really software-driven payment orchestration. that uses, and really the only difference to existing systems is really the encryption and tokenization of pre-approved credentials, right? And so if I get a little technical here, that's kind of really what this means. And so I think, but the biggest gap that still needs to get filled is how this actually relates to what an institution really needs to do. And we touched on this really briefly, but like, you know, like that is one simple part, but it needs to tie into the liquidity sequencing, into the settlement, into all the different components of security, as well as, you know, there's conditional settlement and all these other things, reconciliation that still need to occur, that need to tie into existing frameworks. And so I think in the short term, I think we're at the stage where everyone's moving around POCs, waiting for regulatory clarity, and then to really come up and currently actually building a stack that connects to those respective systems, right? And so, but I do think it'll be a carefully selected few workflows initially that will get tied to agentic payments at scale.
I think that makes sense. I want to go back to something you mentioned, Tom, around going from human-led signing to machine-led signing. How in this like sort of future world do you build those systems then with accountability intact? You know, today you might have a human kind of reviewing a large transaction. What does that look like if it's all machines?
So I mean, you're right. Accountability is not going to disappear. You're not going to be able to say to your risk manager or to an auditor or to a regulator, I'm not sure why that happened. The algorithm did it. Right? There's no black boxes in finance, so that's not going to happen. I think a couple things to think about, and I've spent a lot of time thinking about this, and I have a really kind of interesting vantage point with talking with the builders and regulators and banks and fintechs and everything else. I think if you think about the intersection of models and programmable money is super interesting to me. Mm-hmm. And it's not going to be a factor of I can do 1,000 payments a day. You might get 1 million payments a day. Right, so this idea of bilateral compliance and doing things on a bilateral basis in institutional finance has to change. And you can't be in a situation where you kind of reconstruct the problem after it happens. And so the analogy that I've been thinking about lately and kind of testing with some people is kind of the shipping container, right? Because a token's a digital representation, you know, and we've been able to kind of put assets in a container. Right? Shipping didn't get faster because the container was invented in 1956. You know, trucks didn't go faster, ships didn't sail faster, they didn't get unloaded on docks faster. What really actually changed that was when it became programmable, when the container was sealed, when it had all of the information on the manifest about what was in the container. You know, is it compliant? You know, can you hold it in this jurisdiction? You know, how do you settle it? You know, now that I have the container in the port, how's that payment made? In trade finance, for example. So this concept of, which doesn't exist today, of a programmable container, where all of the details about what's in it and the compliance with it, that as it travels across chain, I think we're gonna have to get that. And I think we're gonna also have to get to the point where that's checked at execution time, or the time when the container hits the port, if you wanna stay with that analogy. That's gonna be done at execution time, because the reconciliation, if you have problems, when you go from thousands to millions, maybe billions, it's just not something that humans can keep up with.
Mm-hmm. I think if I, just looking at this, the question of humans versus machine differently, I think it's really important to understand that you basically have to separate accountability from execution, right? And so the execution layer is going to be fully programmable. That's going to be done by software. The accountability layer still requires humans. It's just the activity that the human engages in looks very different. Meaning, I'll give you a concrete example. Like for our product, our on-prem wallet has an encrypted policy engine. And if you're an institution and you're a customer of our wallet, you have to make these decisions around what are actually the roles and permissions, who can actually engage with this respective wallet. What does the multi-party approval flow look like, who needs to approve what transactions, and what are the transaction limits that these individual roles can do. The logic needs to be developed by a human, and then once it's in place, then you can have programmatic execution against it. And so I think what's so important, and that's why crypto is so interesting and why we have this interesting sort of coalition forming between AI and crypto, is like ultimately all this Web3 stuff wasn't really built for humans. You know, it's like it scales perfectly against machines, but it still needs the human architecture and the physical implementation of rules, basically.
Can I just build on that a little bit? Because you just heard from BlackRock in the previous session. And so if I'm an algorithm and I'm looking at where should I place money, where do I want to actually invest the balance that I have, and I have the authority to do that, and it's in a structured environment. When I get that token from BlackRock, I'm going to say, well, first of all, what is it? Is this a 40 Act fund? Is it a UCITS fund? Is it like what, from a compliance point, what is this? How does it settle? When I give you the token back, what do? Oh, you give me USDT in my wallet. Okay, and we agree on what the wallet is, so KYC is covered, right? Hey, can I hold this thing in Brazil? I don't know. I'm not going to call BlackRock or take a 50-page PDF file and parse through that with AI to figure that out. I think all of those things have to be in that programmable container because humans are not going to be able to keep up with this. And BlackRock's going to want to get that right because they're going to want the distribution, and they certainly don't want their token or their fund to end up in the wrong place, the wrong hands. Of course, they're going to comply with the law. And the people who are receiving it don't want to buy something they shouldn't be able to hold, whether that's by law or by their perspective. I think all of this stuff is going to have to be done up front.
Yeah, I think you guys are both making great points and leads me down this pathway to talking about regulation and how that has an impact. Obviously, you talked a lot about the technical implementation versus, what are the compliance requirements of something? And oftentimes those it's not so simple as just we can technically do it, but, what are all the other pieces that come after that? Where are we now at a point with, the Genius Bill's passed, we're looking for some more clarity from clarity. Are you still being held up in terms of the development of like large institutional solutions for on-chain and payment rails for customers, or can we be moving along with those and offering them?
I mean, I'd say we're still waiting on clarity, meaning reserve requirements. There's lots of questions I think that institutions still have as far as it pertains to the structural enactment of activating all this. And so, yes, there's, I think the OCC just gave some guidance in March, which has been helpful, but we still don't have clarity on all the components regulators require to launch a large-scale service. And so just to be clear, like even like the regulatory oversight requirements for these digital type of things have not been clearly been defined. And so my experience has been that institutions, the minute that there's any gray area legally in anything, they will not engage in it. And so I think that's why we're waiting so desperately on the Clarity Act, because our assumption is the minute that it's there, people will move from POC to real workflow enablement. And then we're still 12 months out until you'll probably see real flow.
Do you have the same perspective?
Slightly different, and this might be a little bit controversial, but I can say in my entire career, and I've been doing this for quite some time now, I've never been held up by a regulator. They have a very specific job to do, right? There's not this kind of regulator in the sky that kind of oversees everything that's happening. Regulators have very specific responsibilities for activities in a jurisdiction. So in the case of the OCC, in terms of writing the rules for Genius, they have a job to do, right? The law gets passed, they're given permission to do that, and then they write the rules, and those are discussed and finalized. And so there's a lot of things you can do leading up to the rules, but you need the rules and you need the certainty. So the biggest difference between retail and consumer and the institutional finance and banks is certainty. So when somebody says, oh, I can have a stable coin and the bank can move something faster and cheaper, that's great. We move messages over the SWIFT network in seconds. That's not what's holding them up.
Yeah,
right?
But I mean, I just want to break a lance for my fellow crypto brethren. I mean, if I'd be foolish to say that regulation hasn't held up development in crypto rails, because regulators very actively try to destroy this industry to some extent, right? Like, so on the digital cryptographic encryption sort of side, regulators have very actively held up development, and I think that the risk associated to it, in my discussions with these banks and stuff, is that there, like, kind of concrete examples, like some of the largest financial institutions were in discussions of launching validators for them, where they earn yield on chain, which is none of them have currently done to date, and the only anything that holds us up is legal. Technically we're there, all the participants have agreed to it, and it's within the legal departments of these banks where it's just like, if we launch this, what would happen? And what you describe is like the wishful thinking for us, that a regulator has a clear view and sits there and we talk to them normally and come to it. I think people are still a little shell-shocked.
It's exactly the right distinction, right? And working in kind of regulated finance and banks. I'm not in a crypto company, so I haven't experienced that myself. But I think the one last thing I would add to this is, you talk about, there's been a lot of discussion about yield on the Genius Act, right? If you think about somebody who's holding USDT in Argentina or Manila or Lagos, they don't care about yield. They're happy they have dollars in their wallets, right? So when we also think about these issues and being held up, so maybe you're held up and you can't do something in the US because we don't have the legislation we need, and the yield's kind of one of the things that need to be resolved, which looks like it will be in short order here. If you're in Lagos and you have $100 of USDT in your wallet, who's better than you? This system's working. I mean, it's the most traction of any stablecoin ever is Tether, and it's all in international market. The world's a big place, right? So if you're held up in one area, the question is, can you someplace else and still stay within kind of the confines of the law and the regulations?
I think that makes a ton of sense. Maybe as we look forward, there's a lot of talk within this space frequently that on-chain rails will replace a lot of the legacy or prior rails that came before them. How do you guys view that statement when looking at it from your POVs? Is there an expectation that there is a replacement? Is there a transitional period? Do they live side by side in the future? What does that look like?
Yeah, I love the question. I've sat on panels before where people say, well, when this happens, I mean, Swift pretty much disappears, right? It's like, yeah, not really. If I could buy stock in Swift, I would, right? The world's only getting, and I can't, nobody can because it's privately held and it's a bank co-op. But the world's only getting more complicated, and the fabric that you need for not only for standards, but for compliance, for integrated workflow into every financial institution in the world, that doesn't change because you have a new type of asset, right? That actually becomes more valuable when you get into algorithms making decisions because you have to have accountability and you have to have traceability and all those things. So I think it's only getting more complicated, and also we're in a really unique position because we can actually now integrate into the workflow new assets like tokenized deposits and deposit tokens and stablecoins and CBDCs in some parts of the world. And we can actually go extend it into new settlement locations like public and private blockchains, right? So the blockchain that we're putting on top of the SWIFT network, the whole idea is composability so that we can connect to the new settlement locations that banks want to get to. So I think we're in a great position. I think it's a needed function. And I think we're going to continue to see volumes grow on the network.
I think I mean, they're not going to replace one another, nor are they going to coexist. They're going to interconnect, right? And so if you think about what digital networks do really, really well, it's liquidity sequencing, lowering of operational friction, speed of execution, but they also do certain things really badly, like consumer protection and compliance. And so I think, and so they'll sort of get interconnected between both. Sometimes pains me to say it. I came from the Bitcoin cyberpunkian world, but having spent a lot of time in this space, I feel like if you want real volume, consumer protection is just really, really important. And I don't know how to build the system in a way where I can bypass all the existing institutions.
So I think instead of things are going to disappear, things are going to materially change, right? The way that settlement's done today. I mean, think about what a correspondent bank does, right? They complete transactions, they do foreign exchange, and they provide float in an account in a different country, a Nostra Vostra account. If you can do instant settlement on a stable coin, those all go away. You don't need that. It doesn't mean a bank won't be involved. I'm pretty sure banks will be involved in that, and they'll offer some pretty clever services to their customers, but it doesn't go away. That friction that was there was set because of the way settlement was set up, 20, 30, 40, 50 years ago, and the banks offer that service, and they charge for and monetize that service. If that gets more efficient, then they'll have to think of other ways to monetize that flow, and the whole thing will get more efficient, but I think you're still going to have banks and regulated financial institutions in the flow.
Great point. Maybe I can get one more hot take out of both of you guys. If you could change, one thing, the way that the industry views digital assets or on-chain systems, like what would it be? What do people have wrong that should be corrected?
Yeah, I think I wish it were less about ideology and more about systems design. And so I think we're getting to a place where it's a really, like the words associated to crypto shouldn't really live within the consumer conscience, right? Like it's a technology that really provides plumbing and execution and settlement. And so I feel like changing that ethos from ideology to systems design is something that I wish would happen more.
I have a more simple one, and you can follow me on X or LinkedIn, and you can see some evidence of this. But in the DeFi world, there's this idea that I win and you lose, zero-sum game. My chain's the best, everybody else has to die, right? That's not how finance works, right? It's actually completely intertangled. I mean, Swift's a good example of how that works. And I would even go so far as to say that Swift was probably the original DAO, right? In terms of what we did and how we connected disparate payment systems in different areas. So this whole idea that one wins and everybody else loses and dies, that's just not how finance works. And if we are going to use the innovations that have come out of the crypto world, including the assets, we're going to have to get over that and figure out how things get integrated much better.
Awesome. Well, Tom, Konstantin, thanks so much. Thank you all for listening, and it was a pleasure to have you.
Thank you.
Thank you.